Hello everyone, good morning and welcome to day 2 of Advanced Audit and Assurance. So let's begin from where we started yesterday. Yesterday I showed you how to use the ACCA Study Hub and how to do a mock paper on the CBE practice platform, which looks exactly like your real exam. Okay, so now let's begin with an important topic that is there in our exam focus. So the topic that we're going to discuss today is like one of the most important topics that we have in AAA, that is completion review and reporting, and there's always a question on this topic. Okay, so we're going to study that topic today and we're going to solve questions on that topic. One of the questions in the exam will focus on completion review and reporting. Recent events may result in adjustments to the financial statements or the need for disclosure note to be added. The auditor will also evaluate the effects of any uncorrected misstatements, as this may lead to a modified audit opinion. In the exam, you may have to evaluate misstatements and suggest additional audit procedures to be performed to reach a conclusion on such matters before stating the impact to report if the issues are not resolved. So basically, in completion review and reporting, we're going to study matters that require the management to change the financial statements, that is to update the financial statements, and the conditions or the result that happens if the management does not listen. So a very simple thing in this is that if there is a misstatement in the financial statement, that means there's a mistake in the financial statement. There are two possibilities that can happen. The auditor will request the management that please update the financial statement, accommodate the misstatement and make the changes. Now the management has two options to deal with it. Option number one is the management will listen to the auditor that okay, yes, there's a misstatement, we will change the financial statement. If the management does that, the matter gets over there and there. But the second possibility is that the management will say, we are not going to update the financial statements because we feel that the matter is not material. In this situation, what will the auditor do? The management has clearly said no, said we are not going to update the financial statements because we don't think that the matter is material. In this situation, what can be done? In this situation, the auditor will again revisit materiality for the matter. That means, since the auditor has said that, please make the changes, and the management has said, no, we are not going to make the changes because we don't think it is material, the auditor will revisit materiality for that matter. That means the auditor will once again check for materiality of that matter. If the matter is really material, the auditor will then contact those charged with governance, because that is the next step if the management does not listen. And the auditor will tell those charged with governance that make sure you make the changes in the financial statements, because if you don't make the changes in the financial statement, it is going to reflect on my audit report. So I am going to change the report. Okay. Now, the next part of this is about the auditor. Now, if the matter is not material, there will be no change in the opinion. So it will be an unmodified audit opinion. But if the matter is material, then the auditor again has two options. If the matter is material and pervasive, or if the matter is not material and pervasive. What is material and pervasive and what is not material, material and not pervasive? Material and pervasive and material and not pervasive have one thing in common. Both the items are material. Material and pervasive means it affects the entire financial statement. So the misstatement you're dealing with over here affects the entire financial statement. That is known as material and pervasive. And material and not pervasive means the misstatement that is there or the mistake that is there, that is material, but it only affects that area of the financial statement. It does not affect the entire financial statement. That means it is material, but it is not pervasive. It affects only that area of the financial statement, it does not affect the entire financial statement. Only that area is affected. The remaining financial statement remains true and fair. Okay, this is regarding material misstatement. So, if the matter is material but not pervasive, a qualified opinion is issued. That is, except for opinion. Means what? Except for this matter, the financial statements show a true and fair view. Okay? And if the matter is material as well as pervasive, that means it affects the entire financial statement, then the auditor expresses an adverse opinion. What is an adverse opinion? The financial statements do not show a true and fair view. This is an adverse opinion. So I hope you guys are clear with unmodified opinion, modified opinion with material and not pervasive, with material and pervasive. So this is how it should be done. Okay. Proceeding forward. In this chapter, we're going to study about subsequent events that are happening after the financial statement date, evaluation of misstatements. This is what I just told you. Misstatements are the mistakes in the financial statements, and how to evaluate and work on these mistakes. Then going concern. We're going to talk about going concern concept. Then we're going to talk about completion and review, that is the chapter heading. Then final analytical procedures, review procedures, and written representations. Written representations from the management. Okay. So let's begin with subsequent events first. What are subsequent events? This is something that is repeated from your AAA syllabus, and it remains exactly the same. Subsequent events is an event occurring between the date of financial statement and the date the auditor's report, and the facts that become known to the auditor after the auditor's report. So what are subsequent events? Is anything that happens after the balance sheet date but up to the auditor's report is issued, and also after the report is issued. Okay. IS 10 events after the reporting date identifies two types of events after the reporting period: adjusting events and non-adjusting events. So part of these subsequent events come under the category of adjusting events, and a part of these subsequent events comes under the category of non-adjusting events. So basically, what are subsequent events? Events happening after the financial statement date, up to before the auditor's report is signed, and also after the report is signed. Events that become known after the balance sheet date up to the auditor's report is signed, matlab up to the signing process is done, in that time frame, it is the active duty of the auditor to take responsibility of the subsequent events. That means the auditor is responsible, because still the signing of the audit report is not done. So it becomes the active duty of the auditor. And anything that becomes known to the auditor after the auditor's report, up to the financial statements are issued to the public, that becomes a passive duty of the auditor. Why it becomes a passive duty of the auditor? Because now the auditor has already signed the financial statement. There is nothing he can do about it. The max to max he can do is a little bit of procedures here and there. Apart from that, there's nothing he can do, because the signing is already done. And he has come to know about this subsequent event, that is the fact after the signing is done. So if he comes to know about something after the signing is done, that means it is his passive duty. But before the signing is done, if he comes to know, then it becomes his active duty. Okay. So this is the division of subsequent events between the active duty of the auditor and the passive duty of the auditor. Now, whatever events that we come to know after the reporting date are classified as adjusting and non-adjusting. Adjusting events means you come to know about the matter, you can go in the financial statements of the previous year and adjust it into the financial statements. And non-adjusting means you cannot adjust in the financial statement. Now, more insight on adjusting event and non-adjusting event. See, this is the active duty and passive duty that I was talking about. Year end se leke auditor's report signed, till that time, whatever comes to know, whatever the company comes to know, whatever the auditor comes to know, it is the active duty. So in the active duty, because the signing is not yet done, so it's an active duty. So whenever it's an active duty, what the auditor has to do? The auditor has to perform procedures to ensure subsequent events have been accounted for appropriately. And once the signing is done, from that point till the financial statements are issued, if the auditor comes to know of anything, it becomes the passive duty of the auditor. Now the signing is already done, so technically the auditor is not really responsible. So that is why it becomes the passive duty of the auditor. And then whenever there's a passive duty of the auditor, what the auditor has to do? No obligation to perform procedures because the signing is already done, but must take action if they become aware of events which would cause a modified opinion. Means if there's a very big thing that you have come to know after the audit report is signed, you cannot ignore that. So he must take actions if you have to modify the opinion. So this is the auditor's responsibility in terms of active duty and passive duty. That is further explained. So this is the active duty of the auditor between the date of financial statement and the date of auditor's report. The auditor should perform procedures to identify events that might require adjustment or disclosure in the financial statements. If material adjusting events are not adjusted for or material non-adjusting events are not disclosed, the auditor will ask the management to make necessary amendments. As I told you, the auditor can request the management if there is anything material, and the auditor can say that, you know what, please adjust it in the books of accounts. So if there is a material adjusting event or a material non-adjusting event, the auditor will request that please adjust it in the books of accounts. If the identified adjustment or disclosure necessary are not made, then the auditor should consider the impact on the auditor's report and whether a modification to the opinion is necessary. As I told you, the management has two options. Either they can listen to the auditor. If they listen to the auditor, the matter gets over. But if they don't, if the necessary adjustments or disclosures are not made, then what? Then auditor should consider the impact on the auditor's report and whether a modification to the opinion is necessary. So if the matter is very, very material, then the auditor will talk to those charged with governance, explain to them that, see, if the management is not ready to make the adjustment, then I might have to change my opinion. Okay. Then what are the procedures in terms of subsequent events? One second. Huh? What are the procedures in terms of subsequent events? What can be done in terms of subsequent events? First of all, about the subsequent events. Subsequent events are events happening after the reporting date. So you have to inquire of management if they are aware of any events, adjusting or non-adjusting, that have not yet been included or disclosed in the financial statements. So they will talk to the management. That is the management aware of any events which are adjusting and non-adjusting that have not yet been included or disclosed in the financial statement. Inquiring into management procedures, systems for the identification of events after the reporting period. Subsequent events on procedures also can come. Then reading minutes of members and directors meetings. That will give us an idea of if really there are any subsequent events in the business. Reviewing accounting records including budgets, forecasts and cash flows. Looking at that also, you will get an idea if there are any subsequent events that are existing. Inspecting after date receipts from receivables. Inspecting the cash book after the year end for payments receipts that were not accrued for the year end. Inspecting the sales price of inventories after the year end. So these are all the subsequent events and the procedures conducted to actually know and understand if really there is a subsequent event or not. So what you will do, inquire of the management procedures reading minutes of meetings, reviewing accounting records, inspection of after-date receipts, inspecting cash book, and inspecting sales price. Now, between the auditor's report and the FS issued, this is what? The passive duty of the auditor. So now what the auditor will do, because the signing is already done, so there's nothing more that the auditor can do. So since the signing and everything is already done, the auditor is under no obligation to perform audit procedures after the audit report has been issued. However, if they become aware of a fact which would cause them to amend the auditor's report, they must take action. It's not like once the signing and everything is done, now so I'm going to close my eyes and sit. If anything happens, I'm not going to do anything. Even after you sign the auditor's report, and even if it's your passive duty now, it's not your active duty, but still, if there is something very big happening, if there's a very big event that happened which will cause you to change your auditor's report, because it's such a big event, then you must take necessary action, because then you're bound to take necessary action. This will normally be in the form of asking the client to amend the financial statement, auditing the amendments, and reissuing the auditor's report. If management does not amend the financial statement and the auditor's report has not yet been issued to the client, the auditor can still modify the opinion. And after the financial statement are issued, if anything that we come to know, then financial statements are already issued, but still something we come to know after that, then what we can do? Again, same like this. It's the same like this. The auditor is again under no obligation to perform the audit procedures because the signing is already done after the financial statements have been issued. However, if they become aware of a fact which would have caused them to amend the auditor's report, they must take action. The auditor should discuss the matter with management and consider that if the financial statement should be amended. The auditor should perform audit procedures on the amendments to ensure they have been put through correctly. The auditor should review the steps taken by management to ensure anyone who is in receipt of the previously issued financial statements is informed. Then next is the matter of going concern. What is the concept of going concern? Going concern means what? Whenever the company prepares a financial statement, there is always an assumption that is taken. And what is this assumption? That the entity is going to be in business for a foreseeable future. So whenever the financial statements are prepared, and submitted to the public so that come and invest in my company. Please come and invest in my company. And those existing shareholders, you're telling them that invest more. So when you're preparing the financial statements, there is always an assumption that the company is going to be in business for at least 12 months from the issue of financial statements. That is an assumption. So it gives an idea to the people that, okay, yes, even if I invest in this company, this is going to be for a long term because the company is a going concern and it's at least going to be in business for 12 months after the financial statement. And this assumption is an unsaid assumption for every company. So going concern is the assumption that the entity will continue in business for a foreseeable future. Going concern is a fundamental principle in the preparation of financial statements. Okay. But if the company has any doubt about its ability to continue as a going concern, then it must not prepare the financial statements on a going concern basis, but it should prepare the financial statements on any other basis like the breakup basis. Now, what is the management's responsibility in the going concern? What is a going concern? Going concern is an assumption that the entity will be in business for a foreseeable future. So, what is the responsibility of the management in this going concern assumption? Management is responsible for preparing the financial statements and must make a specific assessment to the entity's ability to continue as a going concern. Management prepares the financial statement, whether the financial statements should be prepared on going concern basis or not prepared on going concern basis is something which is the management's responsibility. Yes, management is responsible for ensuring that the company is going concern and therefore preparing the financial statements on a going concern basis. This requires making judgments about the future outcome of events or conditions which are inherently certain. So the management should make judgments about the future outcome of events or conditions, whether they are certain or not certain. This will give them an idea if the entity is a going concern or not. Management must prepare the financial statement on a most appropriate basis, that is going concern or breakup basis. So if the management feels that no, there is a lot of problem in the company, there is a lot of cash flow issues, there is a lot of receivable problems, so it's not appropriate to prepare the financial statements on going concern because we don't think the company is going to survive in this competition. So let's prepare the financial statement on breakup basis. That is the duty of the management, to decide if they should be preparing it on a going concern basis or a breakup basis. Okay, if the management feels that everything in the company is going proper, there are proper cash flows, the sales are proper, the purchases are proper, everything is conducted properly, then you prepare on going concern. But if the management feels that no, there is a big loan that is there, and if we don't repay the loan, the bank will confiscate our property and repay the loan, and if the property is gone, we will not be able to conduct business. So either or ways the company will close down. Or if somebody files a legal case on us, and when you ask the lawyers, you come to know that the case is going to be against our favor, and if the case is against our favor, we have to pay a fine, and to pay that fine we have to sell off properties because we don't have that much money, and if we sell off our properties, we don't have a property to conduct business. So situations like these will give the management an idea that we don't think the company is going to go far because there is a legal case on us, and if we lose the case, which we are most likely to, we have to sell off our property and pay the fine. So situations like these will give management an idea on whether to prepare the financial statements on a going concern basis or a breakup basis. And what is a breakup basis? That means this is a last financial statement. We're going to close down the company after that. So the breakup basis requires all assets and liabilities classified as current because this is the last year after which we are closing down. So all the assets and liabilities will be current because this is the last year of the business, and revalued at NRV, that is net realizable value, because we're going to close down any which ways. So it should be at the realizable value. Further provisions for liquidation such as redundancy and legal costs may also be required. Okay, so this is the management's responsibility that you have to be aware of, that is preparing the financial statement on a basis depending upon what the management judgment is about the business. Okay, now the management will try its best to convince the auditor that it is a going concern or it is not a going concern. Is the auditor just going to listen to that? Like whatever the management says, is the auditor going to listen to that? No, right? The auditor is also going to do his own research because the auditor is somebody who's an independent party and he has to do his own research because he's an independent party of the company. So he is not somebody who's just going to say that management, tell me what you feel and then I'm going to listen to that. The auditor will do his own research. If the management says that the company is a going concern, the auditor will do a research to find out if really the company is a going concern or not. And if the management says that the company is not a going concern and the financial statements are prepared on a breakup basis, still the auditor will make sure if really the company is prepared on a breakup basis, if really the company has problems, if really the company has issues. So what is the auditor's responsibility? Obtain sufficient and appropriate evidence regarding the appropriateness of management's use of the going concern basis of accounting in the preparation of financial statement. Is the management's use of going concern basis of accounting in the preparation of financial statement appropriate or not? Like, is it valid? Yes, okay, it is proper. Management has done the right research, or no, the management is lying. The company is actually a breakup basis, but the management is saying no, it is a going concern. And this is a very common problem, because if the companies prepare their books of accounts on a breakup basis, many people don't want to invest in such a company, because you feel, what to invest in this company? It's anyways going to get closed down in a year. So why to invest in such a company? That is why people don't want to invest. And management wants to get the money, because actually they are in a financial difficulty, right? So a lot of times they lie and don't prepare the books of accounts on a breakup basis. They prepare it on going concern only. So the auditor will find out if this is the truth or not. Conclude on whether a material uncertainty exists about the entity's ability to continue as a going concern, and report in accordance with IIC 570. Then audit conclusions and reporting. Based on the audit evidence obtained, the auditor should determine if, in their judgment, a material uncertainty exists that may cast significant doubt on the entity's ability to continue as a going concern, and the basis of preparation of financial statement is or is not appropriate in the circumstances. So what the auditor should first of all determine: is there a doubt on the entity's ability to continue as a going concern? Means, is the entity really a going concern or not? So you have to do, as an auditor, you have to do your own research. You have to check the company, you have to check the cash flows of the company, you have to get external confirmations, and then have an idea that, what do you feel? What is the result of the company? Like, is the company a going concern? Are they able to continue business in the foreseeable future? Or is it like okayish? Or do you think it's very risky, it is going to close down and go into liquidation? That you have to first of all determine. And the second one is the basis on which the management has prepared the financial statement. Depending on these scenarios, is it correct or not? So if it is a going concern, make sure the management has prepared it on a going concern. If it's a breakup, make sure that the management has prepared it on the basis of breakup. Then, what are the indicators which will give the auditor and the management an idea that the company has going concern problems? And that is when you have to prepare the financial statements on a breakup basis. What are those conditions that are going to give you an idea that yes, there is a going concern problem, and we think the company is not going to survive in the market, we think that the company is going to go into liquidation, so it's better that we prepare the books of accounts on a breakup basis? There has to be some indicators, right? And based on these indicators, we can judge if the company is a going concern or not. So the first indicator of going concern risk is the rapidly increasing cost. If the cost in the market is rapidly increasing and we are not able to keep up with that, it's too expensive for us to buy the raw materials, it's too expensive for us to buy labor, it's getting very difficult. That is why we cannot hire more people, because we don't have that much cash flows to pay them. We cannot get a lot of raw materials because we don't have that kind of money. So this is one indicator that we have a going concern risk, because there's a rapidly increasing cost. Then second is the shortages of supplies. Maybe a supplier has gone into liquidation, or maybe the supplier has died, or maybe the supplier has closed down the business, and that was a major supplier. So the major supplier has just closed down. So we have shortage of supplies. Nobody else is ready to give us the raw materials at the rate that old supplier used to give. So again, we are also facing difficulties. Yes, adverse moments in exchange rates. So if your company is such wherein you deal with a lot of import and exports, you know that import and export rates keep on changing. Sometimes the rates can be very much in your favor, but sometimes the rates are very much against you. So here, for a long period of time, the rates are against you. So every time you do an import or an export, you are losing money because the rates are against you. There is an adverse moment in the rate. So every time you're doing an import or an export, you are losing on the exchange rate. Yes, so that is one more indicator that you have a going concern risk, because if you continue doing this, you will go into liquidation. Then business failures among customers or suppliers. You were doing a business of a particular item, but suddenly many competitors came into the market. Therefore, you're losing on customers and you're losing on suppliers because there are better competitors in the market. So nobody wants to buy the goods from you. So you have a business failure because you have a lot of competition in that market. Loan repayment falling due in the near future. Maybe 10 or 15 years back, you took a loan from the bank, which is suddenly falling due now, and you really don't have money to repay the loan. If you have to repay the loan, you have to sell a property and repay the loan. If you don't repay the loan, the bank will confiscate your property and repay its loan. So either or ways, you're going to lose on your property, which is the company's office. And if you don't have a company's office, you will not be able to conduct business. So again, this is an indicator of going concern risk. Then high gearing. What is the meaning of gearing? Gearing is risk. High gearing means high risk in the company. Then approaching borrowing limits. You have exhausted all your borrowing limits. For example, every bank has a limit and only that much loan they can provide to you. You have already exhausted all your limits. Say the limit the bank has is 5 lakhs. You've already taken 5 lakhs worth loan. You have not even repaid that and you want more loan. But the bank is not ready to give you loan because you have already approached the borrowing limits. You have exhausted the borrowing limit. So now you don't have any option from where to get money. If you don't get the money, your business cycle will not go on and then you have to close down. So again, a going concern risk. Loss of key staff. When you started the business, you trained like 5 people and those 5 people were your best. Even if you didn't come to office, they would like manage the entire work. And you took a lot of hard work to train them. You trained them for like a year. And now suddenly these 5 people have left the company. And they have started their own companies. So now again you have to hire people. Again you have to train them. It's a big process altogether. Loss of key suppliers or customers. Your suppliers or customers have switched to different competitors. Okay, they don't want to work with you anymore. They have gone to other people and they started working. So again, you don't have anybody you can sell your products to. You don't have anybody from where you can get raw materials. So ultimately what happens? Nobody wants to buy your goods. You have to close down. Technical obsolescence of product range. The product that you were dealing with is suddenly out of fashion. For example, my company was making computers and that was a very hit product back then. But as and when the laptops came into picture, people thought that why buy a computer when you can buy a laptop which is like a mobile computer. So it's a computer which you can take everywhere. So isn't that better than a computer? So you can take the laptop to office, you can take it home, you can work there, or you can work in the train, you can work in the bus, whatever. So computers became technically obsolete. Nobody wanted to buy it. They became technically obsolete. The technology became old. The technology became obsolete with the introduction of laptops. Yeah, so that is one more reason of going concern risk. If your product is out of style, if your product is not up to the mark, then what's the use? An impact of major litigation. That means anybody has filed a big case on you and maybe the litigation will be against your favor and you have to repay a lot of fine. So these are the indicators that you might face going concern issues in the future if these things occur in your company. The value of written representation from the management. Why is a written representation obtained from the management? So that it serves as a proof. Tomorrow if you don't get a written representation And if the shareholders ask you a question that why this has happened, why that has happened, why management did this, you might not have an answer. You cannot say the management called me and told me. Oral communication is not a proof because people can say, I never said that. So there is always a need for a written representation confirming various facts from the management. When the auditor comes into the company to audit the company, it is the responsibility of the management to provide the auditor with all the information necessary to prepare the financial statement. Okay? All the information necessary should be given to the auditor. So first of all, take a written representation from the management that it has fulfilled this responsibility of it. That means it has provided the auditor with all the information necessary for the preparation of the financial statements. Then second is to support other audit evidence relevant to the financial statement or specific assertions if deemed necessary by the auditor or required by specific IICs. The auditor has been provided with all the relevant information, yes, and all transactions have been recorded and reflected in the financial statement. That means the management has not missed out on any transactions purposely or fraudulently. All the transactions that have happened in the company within the year are all reflected and recorded in the financial statement, and this is the value of written representation. Written representation always serves as a proof. If you don't take written representation, then it becomes a problem because management can say, I never said that, if it is an oral communication. Okay, so that is the value of written representation. Now we take a break of 5 minutes, after which we will continue. The next one we have is reporting. One of the questions in the exam will focus on completion and reporting. Reporting now may be examined in several ways. You may be asked to describe the implications for the auditor's report if issues identified during the audit are not resolved. So if the issues are resolved, then the question gets over. But if the issues are not resolved, then how will it affect the auditor's report? Then second, critically evaluate extracts of a draft report, that is, say what is wrong with it and explain why. So there will be extracts of draft report which you have to criticize and critically evaluate and say what is wrong with it and explain why that report is wrong. Okay, so that is one more reporting exam focus. Then explain the matters the auditor should communicate to those charged with governance. When will the auditor communicate with those charged with governance? I told you. If the management says we are not going to listen to you, if the management doesn't solve the matter, ultimately the auditor has no option but to communicate to those charged with governance. If still the matter is not solved, then what? It will affect the auditor's report. Modified opinion. Then additional communications. In certain circumstances, auditors are required to make additional communications in the auditor's report even though the financial statements show a true and fair view. Even though the financial statements show a true and fair view and they are perfect, but still sometimes the auditor wants to tell some points. The auditor wants to make some disclosures, communications in the report. Everything is proper, everything is perfect, but still there is something that the auditor wants to put in the report. So what the auditor will want to put, if there is any material uncertainty regarding the going concern, but the financial statement shows a true and fair view, then the auditor wants to state that in the auditor's report. Emphasis of matter. What is emphasis of matter? The matter is already there in the financial statement, but the auditor wants to put a light on that matter, emphasize on that, underline that matter. So the auditor will pick that matter from the financial statement and put it in the emphasis of matter paragraph. Other matter is any other matter that the auditor wants to communicate to the shareholders. Any other matter which is not a part of the financial statement but the auditor wants to communicate it. It is important to note that these do not impact the wording of the opinion and do not constitute either a qualified adverse or disclaimer of opinion. Because of these three things, that is material uncertainty regarding going concern, emphasis of matter and other paragraph, it does not impact the opinion. But this is only something additional apart from the auditor's opinion that the auditor wants to communicate to the shareholders. Maybe the auditor wants to tell the shareholders that there is a material uncertainty relating to going concern. There is a matter in the financial statement which requires a very thorough understanding of the shareholders, that is emphasis of matter. And other matter is any other communication which is not included in the financial statements that the auditor wants to explain about. Then the independent auditor's report. Auditor's report is always an independent auditor's report because auditor is not an internal part of the organization. He is somebody who is independent of the company. He's been appointed by the shareholders to go in the company on the behalf of the shareholders and form an opinion on the financial statements. So when the audit work is complete, the auditor will prepare the auditor's report containing an opinion on the financial statement. So the auditor will come into the company, conduct various procedures. Yes, procedures on what needs to be done, how it needs to be done, all the work is done. And after the work is complete, the auditor will prepare the audit report and give his opinion on the financial statement. The objectives of the auditor are to form an opinion on the financial statements based on the evaluation of the conclusions drawn from the audit evidence obtained and express clearly that opinion through a written report. So first of all is you have checked everything. So form an opinion on the financial statements based on the evaluation of conclusions drawn from audit evidence obtained. Form an opinion on that. What is your opinion? That the financial statement is true and fair, or the financial statement is not true and fair, or except for this matter the financial statement is true and fair, or you do not want to give an opinion at all. That is the disclaimer of opinion. Form an opinion. You have checked the financial statement. After that you form an opinion And whatever your opinion is, whatever it is, you express clearly that opinion through a written report. And why have they given so much emphasis on written? Because written thing serves as a proof, it's an evidence. So express clearly that opinion through a written report. The auditor forms an opinion on whether the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. So the auditor's opinion is something which is not like something that comes in his mind and he gave the opinion. The opinion on the financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. Okay, so that is the audit reporting. Now, how the independent auditor's report looks like. So this is how the report looks like. It starts with the title. What is the title? The title states that this is an independent auditor's report. Why the title states that it's an independent auditor's report? So that the person reading the report knows that this is an independent report. It's not influenced by the it's not compromised by the company. It is a perfect independent report. Okay. Then addressee. Addressee is to whom the report is addressed to, for whom the report is prepared. So like for the shareholders of the company. Then auditor's opinion, like the financial statements show a true and fair view, or the financial statements do not show a true view, or except for this, the financial statements show a true and fair view. Then basis for opinion. Whatever opinion you have given, say for example, the financial statements show a true and fair view. On what basis have you designed this opinion? On what basis have you designed this opinion? So that is the basis for opinion. Then material uncertainty relating to going concern if applicable. It's not like every year, every time there is going to be a material uncertainty. Sometimes it might be. So if there is a material uncertainty relating to the going concern, then that needs to be stated. Key audit matters, KAM, important audit matters. Emphasis of matter if applicable. Emphasis of matter means what I just told you. The matter is already there in the financial statement. The auditor just wants the shareholders to emphasize on that. So they put it here. Other information, any other information that the auditor wants to communicate. Responsibility of the management and auditor. Why is it necessary? Very necessary to avoid any conflicts between the auditor and the management in the future. Yes, to avoid any conflicts in the future. Responsibility of the management and auditor should be clearly stated so that in the future they do not fight again and again on this issue. Report on other legal and regulatory requirements if there are any. Other matters if applicable. Signature, the auditor's address and date. Address of the office, so that if there is any issue we can contact the office, we can go to the office and meet the auditor, and the date. Okay, so this is all what is included in the independent auditor's report. Now auditor's opinion. How is auditor's opinion changed, and what is the auditor's opinion exactly? So depending on what the nature of issue is. First of all, the nature of issue is a misstatement, that is a mistake in the financial statement. So if the mistake is not material, it's a very small mistake, so your opinion will be unmodified and you will say that the financial statements show a true and fair view. But if the misstatement is material but not pervasive. What is material but not pervasive? It affects only that area of the financial statement, but it does not affect the entire financial statement. Only that area is affected. So in that case, the report will be modified, and there will be a qualified opinion, that is, except for this area, the entire financial statement show a true and fair view. And if the matter is material and pervasive, means what? The misstatement that is there, the mistake that is there, is affecting the entire financial statement. The entire financial statement is affected by the mistake. It's a very big mistake. So in that situation, the auditor will give a modified opinion, that is an adverse opinion, stating the financial statements do not give a true and fair view. Okay. So that is material and pervasive, material but not pervasive, and not material. The next nature of issue is the inability to obtain sufficient and appropriate audit evidence. That means the auditor has come into the company, but the auditor is not able to obtain sufficient and appropriate audit evidence. He's not able to obtain. Management is not coordinating with the auditor. Management is not giving access of information to the auditor. The management is not coordinating. In that situation, if the matter is not material, there will be an unmodified opinion. If the matter is material but not pervasive, that means it doesn't affect the entire financial statement. Yeah, again, qualified opinion except for. But if the auditor is not able to obtain sufficient and appropriate evidence for the entire financial statement, the auditor will not be able to give an opinion, because he is not able to obtain information only for the entire financial statement. How will he give his opinion? On what basis will he give his opinion? Because normally opinion is given on the information obtained, but here the auditor is not able to obtain information for the entire financial statement, that is material and pervasive. The entire financial statement, he is not able to obtain information. If no information, then no opinion. And no opinion means disclaimer of opinion. If the auditor is not able to obtain information only on receivables or only on cash and bank, it becomes a qualified opinion. But on the entire financial statement, no opinion. He cannot give an opinion because he doesn't have the what you can say, basis on which he can give his opinion. So he will give no opinion, and that is a disclaimer of opinion. The next concept that we have in this particular thing is the forensic audit. Now, what is a forensic audit? It's a topic which is not there in the AA syllabus, but this is something which is there only in AAA. So that's why I thought of just including it here. What is a forensic audit? Specific procedures within a forensic investigation in order to obtain evidence. Yes, in order to obtain more evidence on a matter or to quantify a loss. Forensic, you must have heard when you're watching something which is, like a case study based. So forensic audit is also same. It's a forensic investigation in order to obtain more and more evidence about a matter. The objective is to put the claimant into a position that they would have been if the event had not occurred. This may be compensation for additional cost and or loss of profit. This could include the use of traditional financing auditing techniques such as analytical procedures and substantive procedures, for example, to quantify a fraud or to determine the amount of insurance claim. So in forensic audit, you kind of find more and more information about a matter. So use of traditional financial auditing techniques such as analytical procedures and substantive procedures, for example, to quantify a fraud or to determine the amount of insurance claim. So that is the concept of forensic audit. Now, before we proceed with other requirements of forensic audit, I would like to solve a question on audit reporting. Okay, so please allow me some time. I'll give you a break of 2 minutes before I start with the question. Okay, so I went to the practice study hub, and from the dashboard I'm going to select a question. So on the dashboard, let's select Macau and Company. Okay, and let's start practice of that. So Macau and Company is the question that we have. Look at the requirements. There are two categories in that. Look at the requirement A. Comment on the quality of audit procedures performed, discussing the quality management, ethical and other professional issues raised. Okay, and just look at this. First, you have to always read the requirement. So comment on the quality of audit procedures performed, discussing the quality management, ethical and other professional issues raised. And now the question. It is 1 July 2005. You are a senior manager in Macau and Company, a firm of chartered certified accountants. In your capacity as engagement quality reviewer, you have been asked to review the audit files of Stanley Company and Kowloon Company, both of which have a financial year ended 31 March 2005, and the audits of both companies are nearing completion. So the A part says Stanley Company is a frozen food processor selling its products to wholesalers and supermarkets. From your review of the audit working papers, you have noted that the level of materiality was determined to be $1.5 million at the planning stage. This materiality threshold has been used throughout the audit. There is no evidence on the audit file that this threshold has been reviewed during the course of the audit. From your review of the audit planning, you know that a new packing machine with a cost of $1.6 million was acquired by Stanley Company in June 2004 and is recognized in the draft statement of financial position at a carrying amount of $1.4 million at 31 March 2005. The packing machine is located at the premises of Aberdeen Company, a distribution company which is used to pack and distribute significant proportion of Stanley Company's products. The machine has not been physically verified by a member of audit team. The audit working papers conclude we have obtained the purchase invoice and order in relation to the machine and therefore can conclude that the asset is approximately valued and that it exists. In addition, the managing director of Aberdeen Company has confirmed in writing that the machine is located at their premises and is in working order. No further work is needed in respect of this item. Okay. Inventory is recognized at $2 million in the draft statement of financial position. You have reviewed the result of audit procedures performed at the inventory count, where the test counts performed by the audit team indicated that the count of some items performed by the company staff was not correct. The working papers state that the inventory count was not well organized and conclude, however, the discrepancies were immaterial, so no further action is required. The audit senior spoke to you yesterday, voicing some concerns about the performance of the audit. A summary of his comments is shown below. The audit manager and the audit engagement partner came to review the audit working papers on the same day towards the completion of the audit fieldwork. The audit partner asked me if there had been any issues on the sections of the audit which I had worked on, and when I said there had been no problems, he signed off the working papers after a quick look through them. When reading the company's board minutes, I found several references to the audit engagement partner, Joe Landau. It appears that Joe recommended the company use the service of his brother, Mike Landau, for advice on business development. This is a related party transaction. as Mike is a management consultant. Based on the recommendation, Mike has provided a consultancy service to Stanley Company since December 2004. I mentioned this to Joe and he told me not to record it in the audit working paper. So much data they have given about the same. So before we plan the answer, take some time to reflect on the question and see how to start writing the answer. Till then, I will quickly check the comments on the YouTube channel and see if if anybody has a doubt about yesterday's lecture and today. So I will quickly check the comments on the YouTube channel. Till then, you guys just have a little bit of idea about how to answer this particular question. Okay. Now let's begin. Let's start planning the answer. This is a 25 marker. This is the A part. This is the A part of Makawan Company, that is quality management. Ethical and professional matters. Okay. So just once again go through that. Okay. Quality management, ethical and professional matters is something that you have to discuss. Now starting with the intro of the answer, it's a 13 marker, so you have to write that much. Plus this is a professional paper, so you have to just write it completely. So the audit of Stanley Company does not seem to have performed with a high regard for the quality of the audit, and there appear to be several ways in which the IIC requirements have been breached. Okay, this is one situation. So first look at the materiality of the item. Okay, so put the heading materiality and write about materiality. So first, it is not appropriate that the materiality level was determined at the planning stage of the audit but has not been reviewed or adjusted since then. Okay, then what next can you write about this particular situation? You can say it may be the case that no revision to materiality which was initially determined is necessary, but a review should have taken place and this should be clearly documented in the audit working papers. Because if you have conducted a review, it should be a part of the audit working papers that yes, you have conducted a review. So it should be documented in the audit working papers, and make sure when you're solving the sum, you're solving it here so that when you confirm the answer, you get the correct answer below that. Okay. Then after materiality comes the audit of property, plant and equipment. Yes. So write down the next one, the next para. That is audit of property, plant and equipment. So this is regarding the packing machine. Okay, so you have to look into the matter and then answer, right? So this is the packing machine. You can read it once again if you want and then start with the answer. So basically the audit of packing machine has not been properly carried out. So you will start with like the audit of the packing machine not been properly carried out and there seems to be lack of sufficient and appropriate audit evidence to support the audit conclusion. Okay, this is one step. And they have clearly stated there that the cost of this equipment is material. So, the cost of the asset is material, and based on the initial materiality, therefore there is a risk of material misstatement if sufficient and appropriate evidence is not obtained. Okay, this is step number 2. But by the year end, the value which was material has decreased to an immaterial value. So, by the year end, the assets carrying value is less than materiality, presumably due to depreciation being charged but this does not negate the need for obtaining robust audit evidence for what? The cost of the asset, which was previously material, now by the year end it is immaterial. So for the cost and subsequent measurement of the asset. Okay, so this is that. And then again regarding the packing machine, the machine has not been physically verified by the audit team. Is it right to do so? It ideally should have been physically verified, right? So that you will constitute in the next paragraph. The packing machine should have been physically verified just obtaining the order and invoice does not confirm the existence of the machine or that if it's in a working order. So obtaining just the order and the invoice does not confirm the existence of the machine or that it is in working order. In addition, without a physical verification, the audit team would be unaware of problems because physical verification is not done. So just obtaining the invoice, looking at the bill will not give you an existence of the machine, will not give you an idea of how the machine is, unless and until you go yourself and see it with your own eyes. So without a physical verification, the audit team will be unaware if there are any problems to the machine. What problems? Physical damage. So they will be unaware of problems such as physical damage to the machine, or the machine has become old, or obsolescence, which could indicate impairment of the asset. Okay. Then next, about this last line, the managing director is confirmed in writing. Now we can talk about the audit evidence. Which audit evidence is more reliable and which is less reliable? And no further work is required in respect of that. So the next paragraph can be about the evidence. So audit evidence obtained directly by the auditor is more reliable than audit evidence obtained indirectly or by inference. This is one point, okay, and this is a fact that audit evidence which you yourself go and directly obtained is more reliable than evidence that you have indirectly obtained. Like you have told somebody that please go and get the evidence, then that somebody got the evidence and they gave it to you. So in that process, the evidence might be tampered. They can add a little bit of information and tell you, or they might subtract some information, forget some information and tell you. So that is the reason that the evidence obtained directly by the auditor is more reliable than evidence obtained by inference or indirectly. Then here there is a matter of external confirmation. So external, talk about that. External confirmations can be used to provide audit evidence but in this case the external evidence or rather the external confirmation should corroborate evidence obtained directly by the auditor rather than be the only source of evidence. Okay, so this is the next point. Then talk about this situation relating to the question. See, this is how you have to answer the question. First, you talk about a fact. What is a fact? Audit evidence obtained directly is more reliable than indirectly. Then, what is happening in the question? External confirmation. So, talk about external confirmation fact and then relate the situation to the question. Now, in the next point, you will relate it to the question. What has happened in our company? So, what has happened in our company? The relationship between Stanley Company and Aberdeen Company should also be understood by the auditor, and evidence should be obtained to confirm whether or not the two companies are related parties. Because if they are related parties, by default the matter becomes material, not by size but by nature. Even if it is not by size, then by nature. And if they are related parties, then what? As this would impact on the extent to which the external confirmation can be relied upon as a source of evidence. Okay, this is regarding the audit of property, plant and equipment. That is done. The next we have is inventory count. Yes, inventory at 2 million. So just read through it before you start writing inventory. So see what they've said. The working papers state that the inventory count was not well organized and conclude, however, the discrepancies were immaterial, so no further action is required. So next is inventory count. So in respect of the inventory count, attendance, the audit team should have discussed the discrepancies with management as they could indicate more widespread problems with the inventory count. Now, what is the comment that is given in the question? That the company inventory count is unorganized. So, given the comment, that the inventory count appeared unorganized, it is possible that the count instructions were not being followed, or that some items had not been included in the count. Okay. So what according to the standard should have been the case? Now write the fact. Okay, you have written now what is the problem in the question. Now write a fact and then relate the fact to the question. So what is the fact? While attending the inventory count, the auditor shall evaluate management's instructions and procedures for recording and controlling the results of the entity's physical inventory counting. Inventory is discussed with the management. So write down. It is not clear from the conclusion of the audit work whether the problems noted at the inventory count have been discussed with management. The auditor attending the inventory count should have raised the issue at the time and assessed whether a recount of all inventory was required. Now what happens is these minute problems will not go into action and nobody is going to take action. Ultimately, what has to be done is staff who's counting the inventory should only be given training ki you only solve your problems. Yes, because then the problem will go ahead, then again they will check the materiality of the item. Till then it will be too late to solve the problem. Instead of that, it will be better if training is given to the audit staff only to solve these problems at their level at an appropriate manner, and the audit staff who is counting the inventory also know about how to count, what to do and what not. If you hire some other person, he might not know about what needs to be done. So next paragraph is training may need to be provided to audit staff to ensure that they understand the auditor's role at an inventory count and can deal with problems which may arise in the appropriate manner. Now this problem whichever is recorded at an inventory count is a discrepancy, right? And that needs some further audit work. So this problem is known as discrepancy. So this discrepancy requires further audit work. So the discrepancies noted at the inventory count should be subject to further audit work. The result of the test counts should be extrapolated over the population in order to evaluate the potential misstatement of inventory as a whole, right? Then what else can you write in the inventory paragraph? The next what the auditor can do is the auditor can evaluate all the misstatements, accumulate them together, that is group them together, and the misstatements should be discussed with the management. So the next one we have is the auditor shall accumulate misstatements identified during the audit other than those that are clearly immaterial. Because immaterial, there's no point of gathering them together. So those are clearly immaterial. And that misstatements be discussed with management. Right? Now the next is regarding working papers. Okay, so about the working papers, read this part for working papers. So the working paper review has not been done properly. After a quick look at them. So quick look means he's not properly looked into the matter. So the next point is about the working paper review and discussion with the engagement team be satisfied that sufficient and appropriate audit evidence has been obtained to support the conclusions reached and for the auditor's report to be issued. So they have just had a, what you can say, just gone through the working papers. They have not checked it properly. So it appears that in this case the partner has not properly reviewed the working papers. Instead, relying on the audit senior's comment, relying on the audit senior's comment that there were no problems in the audit work. So you've not even checked the papers correctly. You're just relying on the comments that there were no problems in the audit work. But what is your duty? You needed to look at that, right? The audit partner need not review all audit documentation but only a quick look at working papers could indicate that areas of risk or critical judgment have not been reviewed in sufficient detail. And one more thing is that the audit manager and audit engagement partner came to review the working papers on the same day. This is also an issue. So if you don't get issues, make issues of things, because the auditor is such that he will try to extract problems from situations. The problems are not going to ready-made be given to you. You have to exercise your professional skepticism and try and find out problems. Okay, so find out issues in the situations that are already given to you. So there is also an issue in that the manager and partner reviews took place at the same time and near the completion of the audit fieldwork. At the same time, you tell me, either at least come, don't come at the same time, then it will be like, should I review or should you review? Then it will simply waste time of each other. So reviews should happen on a timely basis throughout the audit to enable problems to be resolved at an appropriate time. Reviews should also be hierarchical according to the complexity of the reviews, and it appears that the audit partner has not reviewed the work of the audit manager. Okay, and finally you have to talk about the ethical considerations of this entire matter. So read this to answer that. So like that you have to go stepwise and talk about the issues. I mentioned this to Joe and he told me not to record it in the audit working papers or to discuss with anyone. What does that mean? There is some problem, that is why he's saying do not record it and do not talk about it to anybody. Yes. So this is a very big ethical consideration and there's a potential threat on it, the threat to objectivity. Yes. So write down about that. Ethical considerations. Finally, there appears to be a potential threat to objectivity due to the audit engagement partner's brother providing a management consultancy service to the audit client. This amounts, what all threats? Self-interest, because the auditor has interest in that, because that is his own brother. So self-interest, threat in that, the partner's brother receives income from the audit client. The audit partner's objectivity is therefore threatened and this is a significant risk due to his position of influence over the audit. He may even receive a commission, you can say, to, he may also receive a commission from his brother for recommending him. So he may even receive a commission from his brother for recommending him. Right? Do you think it's a very simple matter? Because even if it is not material by size, this is definitely material by nature, because it's a related party transaction. So what needs to be done? The matter should be investigated further and the senior member of the audit firm or the firm's partner responsible for ethics should discuss the comments made in Stanley Company's board minutes in order to evaluate this threat and determine any necessary actions. And and determine necessary actions. Then what else? The amount paid to MIC should be known, as well as the real market rate. So that will give us an idea if the transaction is at arm's length or no. So that also point we can write. The amount which is paid to MIC should be made known to determine whether the transaction is at arm's length. Then what else can you write about that? This comment that don't discuss it with anyone and don't record on audit working papers. So write about that in the last paragraph and then conclude the answer. The partner's comment to the audit junior indicate a lack of integrity and indicate that the partner may have something to hide. That's why he's saying that do not discuss the issue with anyone, as well as don't write it in the report. May have something to hide which increases the threat to objectivity and the audit partner may need to be removed from the audit and his work should be reviewed. Now this completes the first part of the question, that is comment on quality of audit performed, discussing the quality management, ethical and other professional issues raised. The next one is this part, wherein you have two requirements split for 7 and 8 marks. This we will do after taking a break of 5 minutes. Continuing with the same. Comment on the matters to be considered and recommend the actions to be taken by the auditor and explain the audit evidence you would expect to find in your review of audit working papers. You can club it and write it together. Okay, so let's read the requirement. Let's read the question. Kowloon Company works on contracts to design and manufacture large items of medical equipment such as radiotherapy and X-ray machines. The company specializes in the design, production, and installation of bespoke machines under contract with individual customers, which are usually private medical companies. The draft financial statements recognize profit before tax of $950,000 and total assets of $7.5 million. The audit senior has left the following note for your attention. One of Kowloon Company's major customers is the Bay Medical Center BMC, a private hospital. In September 2004, a contract was entered into under the terms of which Kowloon Company would design a new radiotherapy machine for BMC. The machine is based on a new innovation and is being developed for the specific requirements of BMC. It was estimated that the design and production of the machine would take 18 months with estimated installation in March 2006. As at 31st March 2005, Kowloon Company had invested heavily in a contract and design cost totaling $350,000 have been recognized as work in progress in the draft statement of financial position. Deferred income of $2 lakh is also recognized as a current liability, representing a payment made by BMC to finance part of the design cost. No other accounting entries have been made in respect of the contract with BMC. As a part of our subsequent events review, inspection of correspondence between Kowloon Company and BMC indicates that the contract has been cancelled by BMC as it is unable to pay for its completion. It appears that BMC lost a significant amount of funding towards the end of financial year 20X5, significantly affecting the financial position of the company. The manager responsible for the BMC contract confirms that BMC contacted him about the company's financial difficulties in March 20X5. The matter has been discussed with Kowloon Company's finance director, who has stated that he is satisfied with the current accounting treatment and is not proposing to make any adjustments in light of the cancellation of the contract by BMC. The finance director has also advised that the loss of BMC as a customer will not be mentioned in the company's integrated report, as the finance director does not consider it significant enough to warrant discussion. Kowloon Company is currently working on 6 contracts for customers other than BMC. Our audit evidence concludes that Kowloon Company does not face a threat to its going concern status due to the loss of BMC as a customer. Your review of the audit work performed on going concern supports this conclusion. So, matters to be considered. And actions to take. So first of all, find out about the materiality of the work in progress in terms of profit before tax and total assets. So please use your calculator. You can use the calculator here and find out. So calculate and find out. I have already done my calculation, so I will write it down. The work in progress represents 4.7% of total assets and is therefore material to the statement of financial position. And what about deferred income? The deferred income is also material at 2.7% of total assets. So both the things are material. Even though the correspondence with BMC is dated after the end of reporting period, BMC was suffering from financial problems during the year ending (20x5). Which was notified to Kowloon company before the year end. Therefore, what does the cancellation of contract justify? The cancellation of the contract appears to meet the definition of an adjusting event because it has conditions which existed at the year end. Management must consider whether it is still appropriate to recognize the work in progress as an asset. So in what situation he will recognize the work in progress as an asset? The costs relate directly to the contract the cost generate or enhance resources of the entity which will be used in satisfying performance obligations in the future. And third, the costs are expected to be recovered. Now this point needs to be further spoke about in detail. So speak about the cancellation of contract. The cancellation of the contract indicates that the cost of work in progress are not recoverable from BMC, in which case the balance should be written off. Then next, audit work should focus on contractual arrangements between purview company and BMC, particularly in relation to the ownership of rights to the design work which has taken place. Then about the deferred income that they have used, what is the accounting treatment of the deferred income? So talk about that. The accounting treatment of the deferred income also needs to be considered. Depending on the terms of the contract with BMC, the amount would be repayable though this may not be the case given that this BMC who has cancelled the contract, right? Then what you can talk about? You can talk about the auditor's opinion. So if any necessary adjustments are not made, there will be implications for the auditor's report which would contain a modified opinion due to material misstatement. Now the matter is significant, so talk about that. Due to the significance of the matter to the financial statements, the contract cancellation and loss of BMC as a customer should be discussed in the other information to be issued with the financial statements in this case in the integrated report. Then what are the auditor's responsibility? The audit firm must consider its responsibilities in respect of other information that requires the auditor to read the other information to identify material inconsistencies if any with the audited financial statements. Kovloon is working on 6 contracts, so it will give an integrated report. So depending on the wording used, in the integrated report, when referring to the company's activities, during the year, and its financial performance, omitting to mention the cancellation of the contract could constitute a material misstatement of fact or a material inconsistency. And finally, the matter should be discussed with the management. So the matter should be discussed with management who should be encouraged not only to amend the financial statements but also to discuss the cancellation of the contract in the integrated report. If management refuses to make the necessary amendments, and disclosures, the matter should be discussed with those charged with governance or the company's legal counsel. Okay, now once you finish writing the answer, you check it once and then you confirm. The moment you confirm your answer, the timer is going to stop. This is your answer that you have written, and this is the standard answer. Compare your answer with the standard answer. And get the results of the same. Okay, so that's about this particular question. Next question about the same topic we will be doing tomorrow. I hope you guys understood this particular question, how to apply completion review and reporting in your answers. Thank you so much for attending this particular session. Day 2, I hope it was useful. Day 3 also we're going to solve questions from the study hub. Thank you so much guys for attending, and please study well for your exam. Thank you so much.